My mission is simple, to help you protect your family and keep more of your money. I'm here to help level the playing field for families and those who seek the truth. There's always a new way to make money, but at the end of the day, it's your family's security and your legacy that matter. And I promise to help you protect what's really important to you. Legacy Money starts now. Hey guys, Barry Page here, creator of Legacy Money. And in this video, I want to share with you how you can avoid the tax bomb and create generational wealth for your family. I've been putting off making this video because I was waiting on the government to announce their stimulus rescue plan. So now we'll have a little something to talk about. I believe you will understand why this is more important than ever to do a little tax planning today. So now that we're here, in this short video, I'm going to share with you the tax bombs that you face and show you how you can strategically move towards a 0% tax bracket during retirement. I'm not an accountant, I'm not a tax attorney, nor do I play one on TV. However, I do have some secure and safe strategies that have been backed up for centuries, well before the tax code was even put in place, that everyday people like you and me can use to create wealth without government plans and without risking your money in the stock market. So stay with me, and in this video, I'm going to share with you the best kept secret of the wealthy and how you can move towards a 0% taxable income bracket during retirement. Now, before we get started, I just wanted to remind you to subscribe to our YouTube channel, Legacy Money. Just hit the little subscribe button and then a bell will pop up. And if you click the bell, you'll be notified of my latest videos. If you have money in a tax-deferred qualified retirement plan, such as a 401k, IRA, 403b, you may be sitting on a ticking tax time bomb. As I record this video, the U.S. national debt is at $23 trillion. And that's before the COVID rescue plan. I know you've been told to maximize your contributions to your 401k and your money can compound without being taxed, and you'll be in a lower tax bracket during retirement. But like much of conventional wisdom, it's BS. Okay, so I just want to give you a real quick peek at usdebtclock.org. You can surf over there sometime when you have some time. It's a fun website. But look here, U.S. national debt, $23,602 billion as of today. But what you also might want to notice is the tax revenue is $3 trillion. $3 trillion in taxes collected, $23 trillion in debt. That's annually. So, but what's even more alarming, if you look down here at the unfunded liability, so that includes Social Security, Medicare, over $132 trillion as of today. We're March 26, 2020. So, fun little website, usdebtclock.org. So the idea that you'll be paying less tax by deferring taxes doesn't add up. So we're going to take a look at some calculations with postponing the tax versus paying the taxes now. The Society of Actuaries says if less tax rates or if tax rates are the same, it doesn't make any difference whether taxes are taken away from you at the beginning and they're tax exempt later, or at the end, so they're tax deferred. It's the same fraction of your money that is left to you. So let's just take a look at that. So let's take the annual contribution to an IRA, 401k, which I believe the maximum today annually is $18,500. And let's just say you're in a 25% tax bracket. It really doesn't matter. But we just want to keep these the same. So your current tax bracket and your withdrawal tax bracket, if they remain the same. And let's say that's 30 years from now. Maybe you're 30 years old, you're going to work till you're 65. It really doesn't matter. I just want to give you this first comparison. And let's say you're getting a 7.5% return. And the reason I use those numbers is they add up to about $2 million, which I'll share with you more here in a moment. But as you can see here, that account grew to $2 million, and your share now would be $1.5 million. The amount due to the IRS is roughly $500,000, $514,089. So you deferred $138,000 to receive or to pay now $514,000. So, and that grew at interest. So just think about that for a minute. So you're not only paying taxes on the amount that you deferred, you will pay taxes on what it grew to, what that amount grew to. So you pay taxes on the entire $2 million at that point. Now people say, oh, well, I'm not going to take $2 million all out at the same time. It doesn't matter if you take your withdrawal, okay, whatever tax bracket that puts you in. So I like to show tax history when I'm speaking to people. These are the highest marginal tax brackets. Now, realize these brackets change just as tax rates change. So they add brackets, they delete brackets. This is all up to Congress and the IRS. But this is the history of taxes. So you see here 1913, taxes were supposed to be temporary. Ironically, 1913, when our tax code as we know it started, that's the same year the IRS and the Federal Reserve were formed. But you can see there was a huge spike. Taxes went up to 73% here. This is the Great Depression. And then you can see when FDR was president, taxes skyrocketed up to as high as 94% for people in the highest marginal bracket. And so here we are over here today. Taxes have really only gone down one time under President Reagan. But, here's first Bush, read my lips, I won't raise taxes. Right here, here's Clinton. Here's the second Bush. Here's Obama. And here's where we are today. So, again, these are the highest brackets, which if you are in that 600,000 plus, you're probably paying in the neighborhood of about 40%. So I'm just going to use an even number here. We were working with 25% earlier. So I'm just going to show you how Congress, the IRS, can change taxes. So let's say somebody is in a 25% bracket. Now, the funny thing is most people will look at their money in their retirement plan and they think it's all theirs. They've forgotten, or maybe it wasn't explained to them correctly, that they are deferring taxes. So you'll owe the IRS taxes that you let defer all of your working years. Every dollar you put in and every bit of growth on that money will be taxed. So if you had a $2 million account balance and you're in a 25% bracket, your share would be $1.5 million and the IRS share would be $500,000. Now, what if taxes go up the way many people think they might? What if they go up to 40%? Well, look at that. The IRS share is now $800,000. Your share, $1.2 million of the $2 million. So again, these brackets, these rates can change. We don't really have control over them. If you just look at the average taxes since they were created in 1913, as we know them anyway through the IRS and the tax code, the average is about 57%. So if they just went up to that, your $2 million now, your share is $840,000. So let that sink in a little bit and think about where we are. According to Alicia Manel, Boston College's Center for Retirement Director, she said it's a very big deal when people realize they only have 2/3 or 3/4 of what they thought they had, talking about in their retirement plan. So if tax rates do happen to be lower during retirement, well, then maybe that's a good idea if you think deferring taxes is a good idea. If you think they might go down, let's just say they went down to 20. So now of the $2 million, then 1.6 is yours. But just ask yourself, where do you think the money will come from to pay for all of these government promises? And you must consider what could happen to tax rates over your entire retirement. That could last 30 or more years. So as you see here, these tax brackets, these rates change just about every time we have a new president. And of course, that could be 4 years, it could be 8 years, but you just have to consider that for the entire time that you may be retired. And of course, now we have more government spending because of the massive cost of the COVID-19 stimulus and rescue plan, which always seem to wind up as a part of the tax code. If tax rates do go up and the markets bounce back and your retirement plan grows, you'll simply wind up paying more taxes on a larger amount. I talk and listen to a lot of economists, and the ones I've talked to think taxes have to go up because of our aging population and our unsustainable debt. Here's what David Walker, former Comptroller General of the United States under Bush and Clinton, had to say. He said, "Our current fiscal policy is unsustainable. We're heading to a future where we'll have to double federal taxes or cut federal spending by 60%. Robert Murphy, PhD, senior fellow at the Mises Institute and Austrian economist, says, if we assume the applicable marginal income tax rate, investment growth, and other variables will be the same today and in the future, meaning if you're in a 25% bracket, you're earning 6% now, 6% then, 25% bracket then paying tax now versus later is a complete wash." But of course, you understand Uncle Sam is broke. And where do you think he will look for money? Okay, so let's take a look at taxation during retirement. As far as you're being told that you could expect to retire in a lower tax bracket, why do you think so many retirees complain that they're actually paying more taxes or they're in a higher tax bracket? Well, there's mainly two reasons, okay? So your sources of income, which is typically an IRA, a qualified plan, 401k, and the like, require something called an RMD, a required minimum distribution at age 72. So RMDs require that retirees start withdrawing from their tax-deferred accounts at age 72, whether they want to or not. And this can push them, you, me, into a higher tax bracket. And these marginal thresholds are very low. I'll cover them a bit in a minute. Number two is the Social Security income tax. Most people have no idea that their Social Security income could be taxed. But depending on the amount and the sources of your income, 50 to 85 cents of every Social Security dollar will be taxed. So those are some pretty astounding numbers. So let's just take a look at some calculators here, and I'll show you how that works. We'll take a look at the RMDs first. So, and we're just going to use the uniform lifetime table to keep it simple. And we'll assume that this person has the account balance that we discussed earlier of $2 million, and they decided they didn't need income at this point. They kept working maybe, or whatever the case may be. But now they're 72, so they're forced to take an RMD. So what would that RMD be? Well, $78,125, according to the IRS publication. So you're forced to take $78,000 every year, which is going to throw you well above the threshold for Social Security income tax, meaning that Social Security income will be taxed at 85%, right? But let's actually take a look at the Social Security income calculator. Now, these calculators or calculations are very complex, and there's a lot of things that go on, but we're just going to keep it real simple, and we'll assume that a married couple has $36,000 of Social Security benefits. That's about $3,000 a month, and that could be a little low if they both worked, or if only one of them worked, that could be about right. But let's say they had that $80,000 from their RMD, the 78 grand. We'll just round it off to say 80, which also would be 4% if you were looking at the Monte Carlo recommended withdrawal rate of 4% of $2 million. Okay, so we got $80,000 of other income, and again, the $36,000 of Social Security benefits, and they're in a 25% tax bracket. Let's just say, again, a random number, just trying to pick some averages here, and we'll calculate that amount. So that means that $30,000 of their Social Security income would be taxed. And assuming they're in a 25% bracket, that's $7,650 per year. So I can probably pull up a calculator here. You'll just bear with me. Let's just say it's zero. We're looking at 30 years in retirement, and we 7650. So that's $229,500 just in Social Security income tax. Nearly a quarter of $1,000,000 right here. I'm sorry if you couldn't see that. $250,000, $229,000. That's $7,650 times 30 years during retirement. That's incredible. Will be transferred away to Social Security income tax. So what is the solution? I'm going to share with you the best kept secret of the wealthy, a way for you to move your income toward a 0% tax bracket. You have a valuable option available that you're probably not hearing much about. And if so, it's only negative. Again, you have to be aware of who is giving you the information and why they might be saying these things. What I'm describing to you is specifically designed, high cash value, dividend paying, whole life insurance, a contract from a mutual company. It's a financial tool that provides multiple benefits. It's what Ed Slott, CPA, an IRA and tax expert, called the single biggest benefit in the tax code. And all I know is that the ultra wealthy have been using it for centuries. And the corporations, the largest banks, they all own billions of it. This asset actually works exponentially because it provides protection from loss, compounds your savings, and offers significant tax advantages. So what we're talking about is a life insurance retirement plan. If you want to get into a 0% income tax bracket, you can do it with a properly structured life insurance policy, a contract specifically designed to work for income. Some of the advantages offered by this particular design tax plan include compounded tax-free growth, no RMDs, required minimum distributions that might force you into a higher tax bracket, no tax triggers that could increase your Medicare premiums, no tax triggers on your Social Security income, which we discussed earlier could be as much as $250,000 in unnecessary taxes, tax exempt cash flow for retirement. A life insurance retirement plan is an effective way to protect and grow your wealth with multiple benefits. It gives you protection. It protects your family. It protects you in case of a premature death. It provides savings. It gives you liquidity. You can access the cash value the entire time instead of having your money locked up in a qualified plan until age 60, 59 and a half. You have liquidity. You have growth, guaranteed growth of your money every year. You have cash flow. You can access it for any reason at any time, and it provides significant tax advantages that we've been discussing. So your dollars work harder. The cash value in your contract is guaranteed to grow every year. Your dividends cannot be lost once they are declared. And in the end, like we like to say in the South, that's lagniappe. The death benefit will be paid to your chosen beneficiary or charity when you die, tax-free. These plans have worked for centuries, long before our tax code and through tough times, like the Great Depression, similar to what we may be going through today. Your savings and gains are locked in once earned, and they won't vanish in this volatile stock market that we're in or any other market event. More importantly, though, you have liquidity, use, and control of your money. These are specifically designed contracts, and only a handful of life insurance companies even offer these types of policies. So you want to work with someone who understands these plans and how to get you as close to the 0% tax bracket as possible. If you'd like to learn more about this secret strategy and how it could work for you, then just request a free consultation through the links at the bottom of this video. And do it right now while you're thinking about it. And if you want to learn more, I'd also like to link to a couple of resources for you. There's a couple of books you might want to read about this strategy. There's two that I'd recommend. First is Smart Retirement by Matt Zagula. And the next one is Confessions of a CPA by Brian Bloom. This one is the capital equivalent value of life insurance. Thanks for joining me today. I hope you enjoyed the video. Please leave your questions or comments below and be sure to subscribe to Legacy Money. I'll see you next time.